the one area, Alex, that we are getting a reaction is in the dollar. And I find that fascinating as well. What is the dollar signaling? What is the dollar telling us about this story? Is it just a positioning unwind? I think that's one factor we need to certainly think about. Or is the dollar basically signaling the idea that maybe the Fed is going to make a policy mistake? Has the buck stopped? My question is actually a little bit more nuanced than that. Does the buck stop here? I think is the question of the day. Let's bring in Bloomberg's Michael McKee, our international economics and policy correspondent, and the one and only Vincent Cignarella, Bloomberg global macro strategist. Vince, let me start with you. Does the buck stop here?
I don't think so. This could actually just be a temporary sell-off. One of the issues that I'm seeing with the dollar is people are always focused on real yields and why are treasuries up and the dollar's down. That doesn't seem to make sense to folks. What is really going on right now is it's still being driven by the consumer. And when you look at real average earnings and you see what CPI is doing to disposable income, if you map that against where the dollar goes, they actually correlate pretty well. And what the FX market is basically telling you is that if the consumer can't keep pace, at some point, dollar assets are not going to be that attractive. We've seen it obviously in fixed income on a 30 basis move in the 10-year. But what the dollar is actually telegraphing is we may be seeing a little bit of a peakish sense to equities if this trend doesn't reverse. And that either means inflation needs to come off, or we need to see wages pick up in order for the consumer to continue to drive growth. And I just point to mortgage rates number headline hit just a moment ago, jumping to 3.45% is pretty much the highest in 2 years. And I can tell you the anecdotal evidence is we're seeing in the real estate market in Westchester County right now the same thing we saw with the pandemic in 2020, except it's being not driven by a pandemic. Everybody stage left exit outside of Manhattan, but rather that the U.S. consumer is getting into that potential feeding frenzy of inflationary expectations where they think next month it's going to cost more than this month. And so they're starting to get on the ball of that kind of buying structure. That's negative for the dollar.
Right, because that means inflation expectations maybe get a little bit more entrenched to the upside. Mike, let's take that view and then flip it a touch. From the Fed perspective, does the bond market, in essence, Mike, believe that the Fed can handle inflation, while the FX market, as Vince is pointing out, doesn't think that the Fed can handle inflation?
Well, I think you have two different markets, Alex. The bond market is looking at basically longer maturities. The shorter tenors have gone up in yield as the price has fallen, as the market gets ready for the Fed to take action, whereas the longer ones, the curve has flattened because they do seem to think that the Fed can handle this. The Forex market, I mean, obviously you could do futures, but basically the Forex market is looking much more short term. And so what you're seeing there is reaction to perhaps even more of a reaction to the economic data. And by that, I don't mean just the CPI number in the U.S. We're seeing inflation around the world. We're seeing some members of the ECB start to talk about, well, maybe we're going to have to act sooner rather than later. And everybody expects the Bank of England to follow the Fed higher. So you're going to have a lot of cross currents in the FX market that you won't necessarily have in the bond market. And so the dollar could continue to fall if we start to see other central banks get aggressive as well and talk about raising rates, and that will make the dollar just a little bit less attractive.
Mike, can I pull together a little bit of what Vince said and put it together with what's happening with the dollar? Vince was talking about the idea that maybe consumer expectations on inflation are starting to become unanchored. The Fed is already talking about the idea, and I'm sure it's on front pages of newspapers, and I'm sure people are referencing it, that we're going to hike 3 times. If the Fed is seeing that the consumer is coming unanchored in terms of inflation expectations, is there going to be a sense that maybe it needs to do more, that it needs to deliver shock and awe in terms of bringing people's expectations down again?
I think it's a little early for that. The Fed's going to be watching to see what consumers do. But remember, they're predicting consumers are going to back off and that the inflation rate is going to come down because a lot of the fiscal help that consumers got is going to start falling off. So a lot of this is going to depend on when inflation goes down, obviously, but why inflation goes down. Is it because the Fed has raised interest rates, or is it because the consumer has just run out of things to buy? We'll find out if if that's the case, but it'll take a couple of months for that to happen.
Yeah, running out of things to buy, that's not a thing, Mike, just so you know. Vince, I want to take it from a different point of view, and this really ties into what we heard from Delta. So they're going to return to profit in the second quarter. France is going to open up, like I mentioned, people starting to buy vacations again. If we see a true reopening and Omicron wasn't as bad as we feared, is that why we're seeing the weaker dollar? People, money flow into other asset classes outside the U.S.
I'm not so sure that's the case. I think what we still need to see it confirmed in the sense of services index PMIs coming up versus manufacturing. I mean, that's the pandemic sort of correlation, if you will. We've seen some reduction in prices paid coming out of the ISM surveys, which is a good thing. And when I look at the data we've seen in CPI and PPI, I know the headline year over year gets everyone's attention, but I think that's I would ignore that and look at month over month. That's the current trend. That's what you want to see. And month over month is either stable or coming off a little bit. So as Mike said, I think the Fed is in that camp that they believe inflation is going to come down, that they can take their time raising rates, if you will, that this isn't an emergency situation. They may see 2 to 4 this year, but not necessarily all coming, one after the other. There could actually be delays to this. I personally would rather see them reduce the balance sheet as opposed to raising rates and let the market take interest rates where they want to take it, and the Fed should follow. The Fed should not be leading the market and telling the market what to do, but rather following suit. And the balance sheet is really, for me, where the Fed should be reacting right now, not in the interest rate environment.
Yeah, I think a lot of people argue with the size of the balance sheet that we currently have, the market and its ability to act as a signaling mechanism may have been broken a little bit. Vince, final quick question from me. Jane Foley was talking about this a little bit earlier on. Did the market just get too long? Is this just a simple position unwind? Is that what we're seeing here in the dollar?
It's very possible, yes. Going into the year, typically you go into the new year and everybody wants to sell the dollar. This year, I think, history has burned all of those positions. And so we went into this year a little bit aggressive. I'm just taking a quick look at the end of this started basically the end of the last quarter or so, where the dollar's come off a touch. What I'm worried about is that people are going to jump on this trade thinking this is for sure what's going to happen. The dollar's going lower. When you look at the other side of this equation, if the pandemic eases, if spending picks up by the consumer, if inflation mitigates, is the way the Fed is calling it, you're going to see real consumer spending pick up. You may potentially see real yields pick up in the U.S. All of that is a dollar favorable. And if we get too stretched on the short side, we're going to see exactly the reverse of what we're seeing right now.